In the last week of March 2021, a private investment firm in Manhattan lost about $20 billion of its own capital in 2 trading days. The firm had somewhere in the region of 30 employees. It had never filed a disclosure of its holdings with the Securities and Exchange Commission. It had never been examined by a regulator, and no rule required either of those things. It held enormous positions in 8 or 9 well-known listed companies: Viacom, Discovery, Baidu, Tencent Music, and others, and it moved their share prices when it bought and when it was liquidated. And here is the sentence the entire episode hangs on: he had never owned a single share of any of them. This is the ground we are going to cover: what a family office is, and why American law deliberately leaves one alone. What a total return swap is, in plain English, and how an instrument designed to be boring made a position of over $100 billion invisible to every regulator and, crucially, to 8 of the 9 banks that were funding it. The 2 days in March when it came apart, the report Credit Suisse commissioned into its own losses, which concluded something remarkable, and the criminal trial 3 years later that concluded almost the opposite. Bill H. Wang ran a family office called Archegos Capital Management, and the first thing to understand is that until the last week of March 2021, almost nobody in American finance could have told you the name. The banks that had lent to him lost about $10 billion between them. Not the fund's investors, it had none. It was his own money, the banks. Credit Suisse, Nomura, Morgan Stanley, UBS, and others took the losses, and one of them arguably never recovered from it. The question this episode is really about is not how a man lost his own money, which is his business, and it is not really about greed either. It is this: at no point did Archegos fail to file a form it was required to file. There was no forged document, no hidden entity, no offshore vehicle, no falsified account. The largest concealed equity position of the modern era was concealed by nothing but the ordinary operation of instruments that every large bank sells and every regulator knows about. Hold the scale of that in your head for a second, because the numbers are so large that they stop meaning anything. A firm of roughly 30 people in one office, with no outside investors, no regulatory filings, and no public profile, had built exposure to listed American and Chinese companies larger than the entire market value of most of the firms in the S&P 500. If you had spent that March asking every regulator, every exchange, and every financial journalist in New York who the largest single holder of Viacom was, not one of them could have told you, and none of them would have been failing at their job. So before we go any further, here is the question I want to put to you, and I would rather you carried it through the next half hour than had it handed to you at the end. If every bank did its job correctly on the information it had, and if no disclosure rule was breached because none applied, then was this a fraud, or was it a design fault in the system itself? Hold on to that, because the 2 most authoritative answers we have flatly contradict each other. The bank that lost the most money investigated itself and said this was not a sophisticated fraud. A federal jury in New York later said it was fraud and sent the man to prison for 18 years. Both of those were reached carefully by serious people looking at the same events. Start with the man, because the record on him was public and it is part of the argument. Bill H. Wang came out of the most admired training ground on Wall Street. Julian Robertson had run Tiger Management and had trained a generation of analysts who went on to run their own funds, the Tiger Cubs, as the industry called them, and the label was a compliment that opened doors. H. Wang was one of them. He left to run Tiger Asia Management, a hedge fund specializing in Asian equities, and for a period he was very successful. Then it went wrong in a way that ought to have mattered later. In 2012, Tiger Asia settled charges relating to trading in Chinese bank stocks on inside information. The record of that was on the public file from 2012, guilty to wire fraud and a 4-year bar from managing public money in Hong Kong. The firm returned outside money to its investors. He reopened as a family office in 2013, managing his own capital under the name Archegos. And that is where the structure begins, because the change from hedge fund to family office is not cosmetic. It changes the entire regulatory relationship. The obvious question at this point is why 9 major banks queued up to finance a man with that on his record, and the answer is not that they missed it. It was a matter of public record, and every compliance department in the industry knew. Several banks did decline him for a period. Goldman Sachs had him on a restricted list and kept him there for years, and then took him off in 2020, at which point it began doing business with him like everybody else. The reason is prime brokerage economics, and they are not mysterious. A client who runs a large, highly leveraged, actively traded book is one of the most profitable relationships a bank can have. Financing fees on the leverage, commissions on the trading, stock lending revenue, and none of the capital cost of owning the position outright. That client is also mobile. If one bank asks awkward questions, there are 8 others who will not. So the competitive pressure runs in exactly the wrong direction. The bank with the strictest terms does not protect itself. It simply loses the business to the bank with the loosest, and then watches that bank book the revenue. That dynamic is the reason bank risk limits have to be enforced from somewhere other than the desk that earns the commission. And it is precisely the failure the Credit Suisse report later described. A family office is a genuine and deliberate hole in the rules, and it is worth being fair about why it exists. The logic is straightforward. The investment advisor regime exists to protect people who hand their money to somebody else. If you are managing only your own family's wealth, there is nobody to protect. Congress wrote that into the Dodd-Frank reforms after 2008, and the Commission then wrote a rule defining which firms qualify. A family office that takes no outside money does not register as an investment advisor, files no advisor paperwork, and is not subject to examination. Notice what that exemption is actually calibrated for. It is calibrated for size of harm to clients. It is not calibrated for size of position in the market. A family office with $100 million and a family office with $100 billion of exposure are treated identically, because the rule is asking who might get hurt inside the firm rather than what the firm might do outside it. Archegos had no clients to hurt. It had counterparties, and counterparties are supposed to look after themselves. Now the instrument, because the instrument is the whole story, and it is much simpler than the name suggests. A total return swap is a contract between a client and a bank. The bank goes out and buys the shares. It keeps them on its own books in its own name. And it agrees with the client that it will pass across every penny of the return on those shares. The price rises, the dividends, while the client agrees to pay a financing fee and to cover every penny of any fall. The bank owns the shares and he owns the outcome. That is the sentence to keep. Legally, the bank is the shareholder. It votes the shares, it appears on the register, and if a disclosure threshold is crossed, it is the bank that reports, because the bank is the one that holds them. Economically, none of the risk is the bank's at all. It has passed the entire gain and the entire loss to a client, and it has kept a fee and a margin requirement. There is nothing improper about that instrument. It is used every day for entirely mundane reasons by pension funds and insurers as well as by hedge funds. But look at what it does to the disclosure system. American ownership disclosure is built on the idea of beneficial ownership of shares, cross 5%, and you must tell the market who you are. Wang crossed nothing because he owned nothing. The banks held the shares, and each bank held a slice, and a bank holding shares as a hedge against a customer position discloses in its own name as a broker-dealer, which tells the market nothing about who is behind it. At its peak, the gross exposure was above $100 billion, on capital that was somewhere in the region of 10 to 20 billion. That is leverage of roughly 5 times, which for a concentrated equity book is very aggressive, but is not extraordinary in isolation. The extraordinary part is the next number. 9 prime brokers were carrying pieces of it. Credit Suisse, Nomura, Morgan Stanley, Goldman Sachs, UBS, Mitsubishi UFJ, Wells Fargo, Deutsche Bank, Jefferies. And here is the mechanism, stated as plainly as I can. Each bank could see its own book and nothing else. Each one knew its own exposure to Archegos, its own margin arrangements, its own concentration. Not one of them could see the other 8. There is no facility anywhere in the American system that aggregates a client's swap positions across prime brokers and shows the total to anybody. Not to the banks, not to the SEC, not to the Federal Reserve. So 9 institutions each ran a risk assessment. Each got a defensible answer, and the answer to the question that actually mattered, what is this man's total position in Viacom, was not held by anybody on earth except the man himself. That is why I keep saying invisible by construction rather than concealed. Concealment implies somebody hid something. Nothing was hidden. The information simply had no place to be assembled. There is one more piece of plumbing to understand before the collapse makes sense, and it is the margin. When a bank finances a swap, it holds an initial margin against the client's position, a cushion, expressed as a percentage, that is supposed to cover what the bank would lose while it liquidated if the client stopped paying. Set it correctly, and the bank survives a bad week. Set it too low, and the bank is effectively lending against the client's optimism. Credit Suisse was charging Archegos a static margin of around 10%. Static means it did not move when the risk moved. Think about what 10% buys you on a concentrated book in volatile single names. It covers a 10% fall. On a stock that can drop 30% in a session when a large seller appears, and on a position too big to sell in a session anyway, that cushion is gone before the liquidation has properly started. A dynamic margin, one that rises as concentration and volatility rise, would have demanded multiples of it, which would have forced the position smaller long before March, which is the entire point of having one. So the picture by early 2021 is a book of roughly 5 times leverage, concentrated in a handful of names, financed by 9 banks who each see a slice, several of them holding a cushion sized for a normal market against a position that could not be sold in one. The positions were concentrated, and that is what made it fragile rather than merely large. This was not a diversified book. A very substantial share of the exposure sat in a small handful of names, several of them mid-sized companies whose ordinary daily trading volume was a fraction of the position Archegos had built in them. It is worth knowing what the names were because the choice of them tells you something. 2 broad groups. American media companies in the middle of the streaming re-rating Viacom, CBS, and Discovery, both of which had roughly tripled over the preceding months on the theory that any company with a library was about to become the next Netflix. And a set of Chinese companies listed in New York as American Depository Receipts, Baidu, Tencent Music, VipShop, IQIYI, and the education company GSX Techedu, which had already been the subject of published short seller allegations that it was overstating its student numbers. That is not a random book. It is a set of stocks with big stories, heavy retail interest, high volatility, and in several cases, a relatively small free float, which is to say, exactly the kind of share where a determined buyer with unlimited financing can move the price, and where the price will move a very long way when he stops. Every quality that made those names attractive on the way up made them lethal on the way down, and the two features are the same feature. That matters for a reason that is easy to state, and was apparently easy to underweight. When your position in a company is many times the amount that normally changes hands in a day, the price you see on the screen is not a price you can actually get. It is the price of the last small trade. If you ever have to sell the whole thing quickly, there is no buyer at that level, and there is no buyer at anything like it. The book was therefore worth what it said it was worth only for as long as nobody had to sell it. There was a second effect, and it is the one that produced the criminal case. Buying that heavily in a thinly traded name pushes the price up. A rising price increases the value of the collateral, which supports more borrowing, which funds more buying. Run that loop for long enough, and it becomes genuinely difficult to say where investment stops and where holding a price up begins, which is exactly the argument the government later made to a jury. The unwinding began with a piece of ordinary corporate housekeeping that had nothing to do with Archegos at all. Viacom CBS announced an equity raise on the 22nd of March, a straightforward decision by a company whose share price had roughly tripled and which sensibly wanted to sell stock into the strength. New shares dilute existing ones, and the market took the price down. For anybody else, that is a bad week. For a holder whose collateral was that share price, it was the beginning of the end, and the attempt to support the stock by buying more of it only used up cash that was about to be needed. By Wednesday, the margin calls were arriving and could not be met. And at that point, the structure that had made the position invisible turned around and did something worse. It made an orderly exit impossible. It is worth walking the week, because the speed is the thing people find hardest to believe. Monday the 22nd, the offering is announced. Tuesday and Wednesday, Viacom falls hard, the collateral value falls with it, and the margin calls begin to arrive from more than one bank at once. This is the moment the nine-slice structure stops being an advantage and becomes the trap, because Archegos cannot meet them all, and each bank, on receiving no money, has to decide independently and immediately what it is holding and what it can sell. By Wednesday evening, several of them had worked out that they were not the only lender and had begun to guess at the size of the hole. That is a genuinely extraordinary sentence. The people funding the largest concentrated equity position in the market found out how large it was by watching it fail. On the Thursday, the prime brokers met to try to agree a controlled wind down, and the meeting failed. The logic of the room was brutal and entirely predictable. If everybody sells together and in proportion, everybody takes a bad, survivable loss. If one bank breaks and sells first, that bank gets out near the screen price, and the rest are left selling into the crater it makes. There was no agreement, no mechanism to enforce one, and no regulator in the room. Goldman Sachs and Morgan Stanley moved first and fastest, and got most of their exposure away. The banks that hesitated, or that had been slowest to understand what they were holding, were left with the rest. Credit Suisse alone lost about $5.5 billion, and it was the slowest of the group. Nomura took about $2.9 billion. Morgan Stanley and UBS took several $100 million each, Mitsubishi UFJ a few hundred more. Goldman and Deutsche came out roughly flat. So the same event, on the same position, produced losses ranging from nothing at all to $5.5 billion. And the only variable was how quickly each institution reacted. Credit Suisse then did something unusually useful, and I want to give the bank credit for it because it is rare. It commissioned an independent law firm to investigate its own conduct, gave it access, and published the result. The report's central finding is a single sentence worth hearing. The Archegos matter was not the result of a sophisticated fraud, but of a fundamental failure of risk management. It went further. The margin the bank was charging Archegos was static, at around 10%, on a concentrated and volatile book, where a dynamic margin would have demanded far more. Internal risk staff had raised the exposure repeatedly and had been unable to get it acted on. Limits were exceeded, and the response was to raise the limits. The report described a culture in which the risk function had authority on paper and no traction in practice. That report matters beyond Credit Suisse because it is an admission against interest, and there were not many of those. It says nobody deceived us in any complicated way we could have asked. We had the information about our own exposure, which was the part we were responsible for, and we did not act on it. Within 2 years, Credit Suisse had ceased to exist as an independent bank, absorbed by UBS after a separate crisis of confidence. And while Archegos did not cause that on its own, it is very hard to find anybody who thinks it was unrelated. One thing before we go on. If you subscribe, it genuinely helps this channel keep going. And there is a new piece of American financial history every single day. And leave a comment while you are here. It matters more than you would think. And then the courts took a different view entirely, which is what makes this case worth an episode rather than a paragraph. The indictment came out of the Southern District of New York in April 2022. Racketeering conspiracy, securities fraud, and market manipulation. Patrick Halligan was the chief financial officer and was charged alongside him. The government's case was not that the swap structure was illegal, because it is not. It was that Archegos had lied to the banks, misrepresenting the size and concentration of its positions elsewhere when asked, and understating how much of a given company it controlled, and that the buying in the final months was not investment but a scheme to hold prices up. That is a crucial distinction, and it is the reason both findings can stand. The invisibility was lawful. What the jury found was that when the banks did ask the right questions, they were given wrong answers. The jury convicted him on 10 of the 11 counts in July 2024. He was sentenced to 18 years, which is a very long sentence by the standards of American financial crime, and considerably longer than the government's own guidelines calculation had been expected to produce for a defendant who had lost his own money rather than customers. Now compare that Thursday meeting with the one everybody in that room would have been taught about, because the comparison is the sharpest thing in this whole story. In 1998, when long-term capital management was about to be liquidated into a market that could not absorb it, the Federal Reserve Bank of New York put the heads of the major firms in a room and did not let them leave until they had agreed to recapitalize the fund and unwind it slowly. No public money was used. What the Fed supplied was not cash. It was the room and the authority to make an agreement stick. In March 2021, there was no room and nobody with the standing to convene one. The banks called each other, understood the logic perfectly well, and could not act on it, because an agreement that nobody can enforce is worth nothing the moment one party's own risk committee tells it to sell. Goldman and Morgan Stanley did what any institution with a fiduciary duty to its own shareholders would do. It is not even a criticism of them. The first mover was going to be rewarded, and everybody knew it, which is exactly why somebody has to stop the race rather than ask people not to run it. That is the strongest evidence for the design fault reading, and it does not depend on anybody's honesty at all. The 1998 problem was solved by an institution stepping in. The 2021 version of the same problem was not, and the reason is not that regulators had grown lax. It is that in 1998 the authorities knew LTCM existed, and knew roughly how big it was. And in 2021, nobody knew Archegos existed until it had already gone. So which is it? And this is where the two findings collide in a way that I think is genuinely unresolved. The Credit Suisse report says, "This was not clever, we were careless." The verdict says, "He lied to us and manipulated a market." Both can be true at once. A man can deceive a counterparty that was not looking very hard, but they point at completely different remedies. If it was fraud, the answer is prosecution, and that has happened. If it was a design fault, prosecution changes nothing at all, because the next Archegos will be run by somebody who simply does not lie, and the position will be exactly as invisible as this one was. I lean towards the second, and here is why. Take the lies out of this story entirely. Imagine a family office that answers every question from every prime broker completely honestly, and simply declines to volunteer what it has not been asked. Nothing about the structure changes. 9 banks still see 9 slices. No regulator still sees a total. The concentration is still unmeasurable, and the fire exit is still too narrow for 9 people. The fraud made it worse. It did not make it possible. What actually changed afterwards is smaller than you would hope, and it is worth knowing precisely, because it is a good measure of how hard this problem is. The disclosure deadline was shortened in 2023. The filing window narrows from 10 calendar days to 5 business days, and the Commission also clarified when certain cash-settled derivatives count towards beneficial ownership, which is a real change and does bite on part of the problem. A rule requiring large security-based swap positions to be reported was proposed and has had a long and contested passage. What nobody has built, and what would actually have prevented this, is a place where one client's total exposure across all its prime brokers is added up and looked at by somebody. The exemption itself was not touched, and that is the part worth dwelling on, because the family office is not a curiosity. It is one of the fastest-growing structures in global finance. Thousands of them now exist, a great many of them created in the last 20 years by people who made a fortune in technology or in private equity, and the largest of them run sums that would have placed them among the biggest hedge funds of the 90s. They employ former traders, they take leverage, they use derivatives, and by design nobody outside them has to be told anything. Every individual justification for that is reasonable. A person managing their own family's money genuinely does not need the protections built for other people's clients, and there is something distasteful about a state that demands a public accounting of a private fortune. The problem is only that the exemption was written as an answer to a question about consumer protection, and is now doing load-bearing work in a completely different question about market stability, which it was never designed for and was never tested against. That is why I said at the start that this is a story about a design fault rather than a villain. A rule written for one purpose in 2011, an instrument sold for another purpose since the 90s, and a market structure in which no single institution has the standing to add up what a client owes across 9 competitors. None of those 3 things is wrong on its own, and nobody chose the combination. It assembled itself quietly over about 3 decades, and the first time anybody looked at the whole of it was the week it fell over. The banks changed more than the rulebook did, and that is usually how it goes. Margin terms for concentrated single-name swap books were tightened across the industry. Several institutions reviewed how much they were willing to lend against illiquid positions, and the question of what else a client has on elsewhere became a much harder one to wave away. That is a real improvement, and it is also the kind that softens quietly over a decade of good years. And now the argument on the other side, which is stronger than the tone of most coverage allows, and which I think has to be stated fairly. In one important sense, The system did exactly what it was designed to do. $10 billion evaporated in 48 hours and no taxpayer paid for any of it. No bank failed that week. No depositor was affected. No fund of ordinary savers was wiped out, because Archegos had no outside investors to wipe out. The losses fell precisely on the institutions that had chosen to take the risk and had been paid to take it, and they were absorbed out of capital that regulators had spent a decade after 2008 forcing those institutions to hold. That is not nothing. Compare it with 2008, where a shock of a similar shape ran straight through the banks and into the public finances of half the world. On that measure, the post-crisis capital regime passed its test, and the people who built it are entitled to say so. The rebuttal is about luck and about size. 10 billion is a survivable number. The position was over 100 billion, and the concentration was in mid-sized companies rather than in anything that carried the wider market with it. Nothing about the structure guarantees the next one is that size or sits in those names, and nothing in the structure would tell anybody in advance if it were larger. The system absorbed this because it was small enough to absorb, which is a comforting fact about this event and not a comforting fact about the mechanism. The last thing worth saying is about the shape of the thing rather than the man. Every large financial accident of the last 40 years has a version of this at its center, a position that is legally one thing and economically another. In the savings and loan collapse, it was assets carried at a value nobody could get for them. In 2008, it was risk that had been sold on and quietly bought back. Here it was ownership without owning. The instrument changes and the pattern does not, because the reporting system is built on legal categories and the risk lives in the economic ones, and there is always a gap between them for somebody to stand in. $20 billion of his own money and $10 billion of somebody else's, on a book that no single person on earth could see in full, including, right up until the last week, most of the people lending against it. He did not find a loophole. He walked through a door that was standing open, and the argument that is still going on is about whether the crime was walking through it or leaving it open.